We will revisit liquidity, earnings, and valuation. Over to you, Vikas.
Shall we start or wait for a few minutes? Just wait. A lot of people are joining. Just wait for a minute or so. Start. Uh, Good afternoon, everyone. Welcome to Carnelian quarterly call, catch-up call. Uh, Thank you very much for joining this afternoon. I always look forward for this conversation with all of you. Uh, uh, from two point of view, a more to give you update of what we've been doing, how we have done, what are our thoughts, and more importantly, to hear from you. What are the questions on your mind? I always gain a lot from the questions all of you ask on every quarterly calls. For us, they are a very big source of insights. So I do encourage all of you to ask those questions during the call, post call, and make it interactive, because the real benefit comes or juice comes out of these conversations only with all of you. So with that, let me start. I think like every call, we will also today first give you update on what's happening on our portfolios, what worked for us, what did not work for us, what have we've been doing in last quarter or so, and more importantly, how do we see things panning out from here, both on earnings, liquidity, valuations, because I'm sure we keep getting a lot of questions around these aspects. Are market value overvalued? Are markets expensive? Do you see any risks? So I think we will have some conversation around that. And are there any sort of interesting themes which we are picking up? So I want to make it a little, very, rich in the content across all this kind of points. So do please, keep asking questions if you have any more questions around that. So a quick update on our portfolio performance. As you know, that our first fund, which is Carnelian Compounding Fund, which we started in 2019. This fund last quarter was up about 2.2% versus benchmark of negative 2.4%, giving an alpha of 4.5%. In last 12 months, this fund has delivered 22% return, generating alpha of 15.6%. More importantly, since beginning, it has delivered an alpha of 6.5%, generating return of 18.8%. This is all post our expenses. So it's a net of fees we have delivered over last 4 years, an alpha of over 6% per annum. Similarly, the compounder strategy, which we started with an acquisition, later, and there again, if you see in last 3 months, we have had delivered alpha of 3.5%, or last 12 months, alpha of about 8.6%. So, and both portfolios are more or less similar. The since inception numbers are not comparable because this was an acquisition of existing strategies. So the earlier number is not sort of comparable, but this is more or less in the recent past, they are more or less replica of each other. Next strategy which we have is what we call shift strategy. As most of you know, that this was a strategy we launched in October 2020, 3 years earlier. 6 months after pandemic, where we picked up two big structural themes, namely manufacturing and technology. We were very ahead of entire market in this, launching a manufacturing and technology fund in October 2020. This fund has delivered great returns over every period. In last 3 months, it is up 6.4%, delivering alpha of 7.8%. In last 12 months, it has delivered alpha of 36%. Absolute return of 46.1%. Since inception, it has delivered 44% return versus benchmark of 21, delivering an alpha of 22%. Right? These are all, since inception annual numbers. So we have delivered, if anybody invested 100 rupees, it is 300 rupees in last 3 years in our fund. These are all post expenses return. Similarly, the same strategy we launched in AIF form. This we did in April 2022. Theme remains same. It is just an AIF, and with a bit of a difference that it has a pre-IPO element also. So this strategy again has delivered this last quarter, 6.3% alpha. Last 12 months, about 23% alpha, and since inception, about 21% alpha and a 28% CAGR return. So this strategy again continues to deliver very well, and we remain, as confident as ever about the sustainability and potential of this theme, because we think it's a decadal in nature, and it's here to stay. Of course, there will be periods of ups and downs, but structurally speaking, this is one of the most promising theme of India. Another strategy which we have, what we call Carnelian bespoke strategy, which is again a customized portfolio we do for our large clients. Where we each portfolio could be quite different depending on what mandate we have from the client. This strategy again has delivered about 2.5% in last 3 months alpha. In last 12 months, delivered again about 28% alpha and 38% absolute return. Since inception, again, strategy has done very well, 29% absolute return CAGR and 22% alpha. Again, here the quality customer portfolio returns can vary quite a bit, but this is just a consolidated return across all our client portfolios. Lastly, yield and growth strategy, which we launched last year, where the focus is generating 4 to 5% dividend yield, 10 to 12% earning growth. This was conservative strategy we launched last year, betting against a fixed income portfolio. This strategy again has done well, surprised us, even our own expectation. Last quarter, it delivered 4% absolute return and 5.6% alpha. And in last 12 months, 40% absolute return and 30% alpha. And since inception, about 29% return and alpha of 20%. So this strategy has also done well. So as you would have noticed, across all our products, across all time periods, our products and performance has been reasonably robust. And the themes which we have picked up time and again, have kind of really delivered to their potential. Other thing which we always tell our portfolios, we measure against these three things: faster, stronger, and cheaper. Meaning our portfolio should grow faster than the benchmark in terms of revenue and earnings growth. And as you can see, this is for the compounder portfolio, that our revenue and earning growth are expected a faster growth. It should be stronger, as in ROE should be better. So here we have 17% ROE of our portfolio versus benchmark 14.2%. Debt to equity ratio should be better, which makes our portfolio company strong. So we don't like highly leveraged companies. So our debt to equity ratio is 0.1 versus benchmark of 0.6. And there should be margin of safety in the valuation, meaning our portfolio should be cheaper than the index. And this is how it is. And if you see result of all these things, the beta of the portfolio. So we have lower beta, meaning we have taken lesser risk and delivered almost 6% outperformance per annum over last 4 years. This is the strength of this qualitative build-up of the portfolio. And same thing I can say for the shift strategy, which again, faster, stronger, cheaper, faster in revenue and earning growth, which is visible from both these bars. Stronger on ROE, again 18.7% ROE versus benchmark of 14.2% ROE. Debt to equity ratio, and as you can see, our debt to equity ratio is almost debt-free company. So most of our companies are almost debt-free company. A little bit it might look misleading because some of the companies have cash, so netted off, but it's not that all our companies are debt-free. But at a consolidated basis, it might become it's debt-free. Valuations wise, again, they are same valuation as index, but the growth is faster. And if you look at this portfolio, despite being mid and small cap, and our beta of the portfolio is 0.6. So this clearly tells you that the inherent stock selection which we have, the criteria which we choose, and especially also the resilience of the underlying theme of the strategy. Volatility is very very less in the strategy in the portfolio, and that again gives us huge amount of comfort around what we've been doing. So this is a little bit of qualitative color on our portfolio. Faster, stronger, cheaper, and we constantly keep on asking ourselves on this, benchmarking ourselves on this. The day we feel that we are not able to find idea, that will give us idea, that will give us sense that something is changing in the market. So this also in some sense constantly keeps on showing us mirror. Now, what is the story behind our numbers? What have kind of worked well for us? What has not worked well for us? So, if you just look at if we what has happened on the earnings of our portfolio in last one quarter, this is the earning, PAT growth YOY of all our portfolio strategies. They range between 24-28% at a consolidated basis, right, at a portfolio level versus Nifty benchmark of 17.7%. And I will again, discuss this when we come to the earnings growth at a market level. But right now, it just shows that in last quarter per se, what specifically happened, right? And same way on a QOQ basis, our portfolio has grown in earnings far, far higher than. And that probably tells you that why our performance also, generally speaking, markets like high growth companies, which are sustainably delivering high growth. So our endeavor is to choose those companies which can sustainably deliver high growth. And this is what our portfolio is right now positioned. What worked for us, we've been very, very bullish, convinced about the capex cycle, which has been there in the last couple of years. So our portfolio is overweight in manufacturing, engineering, and capital goods. And in this quarter, that has really, really worked well. Many stocks in this basket has performed very well. IT, we consciously went underweight large caps and overweight mid cap IT, and that has again phenomenally done well for us. Many of our IT stocks, in last 1 year has been up between 60 to 100%. This is despite the wide prevalent view that IT is not doing well, and I will talk a little bit more about in a minute. We have been overweight auto component again, that is delivering superior growth. Pharma, API, CDMO player, healthcare, we've been overweight. That has again done wonders for us. One thing I would say that we have been consciously underweight consumer over last 4 years. We have not been able to find any, any structural play where we could, take high conviction call on consumer, where the valuation growth, everything was in favor, and we've been kind of underweight or avoiding this sector for last 4 years, and that has again paid us rich dividends. Of course, we've taken some niche companies like, companies like Senco. When it went to the public, nobody was ready to buy them. I think the IPO was muted, received muted response. So we bought in IPO and we bought on listing, and that stock has again in last 6 months or post listing, which is I think less than 6 months, almost given 80 to 100% return. Right. So whenever, it's not that we are against consumer names, but whenever we find something very compelling, interesting, then we don't seek for a market approval or consensus. Then we just take a bet based on our conviction. And this you will find across our same thing we did when in healthcare, when Yatharth IPO happened. We took pre-IPO, and we also kind of it was not very well sort of received or listed stock, but we bought more on listing because our conviction, just because it had a muted listing, did not change. We bought on listing, and I think that is again since listing, which is I think less than 3 or 4 months, has delivered almost 35% return. So whenever we find something interesting, compelling, good entrepreneur, good idea, market may or may not approve it, but we are very happy to take those kind of consensus call. So our approach continues to remain, which has worked very well for us, and we will continue to approach with the same way, that high conviction, non-consensus call, which also gives you slightly differentiated with a differentiated perspective, but gives you also a significant alpha. So our magic and compounder framework, which most of you are aware, you've heard us many times. We continue to operate from that framework, and we keep on looking for our magic ideas all the times. For those who have joined the first time, our magic framework basically looks for companies with a view to capture both earnings growth and valuation re-rating. When both comes together, you make supernormal return. And this is we at any point in time, we monitor about 80 to 100 ideas in that framework. It's our own proprietary development framework, that what are the situations when this magic event happens. And, we constantly look for ideas under that, and that has served us really well over the last 4 years. These are some of the names which worked in last 4 years. Indostar Capital, again, we took a very non-consensus call. It has delivered 70% return this year. Jammu and Kashmir Bank, in less than 6 months' time, delivered 50% return. Again, you will not find in many portfolio this company. IT company, like I was saying, this year, most IT stocks, despite prevalent view that IT is not doing well, had delivered between 70 to 260% return. Newgen worked very well for us this year. Again, we bought the stock when the stock was going down, market was selling it off, and we were very comfortably happy to buy the stock, because we were convinced about the management and the story behind it. Only 1 quarter of disappointment was there, and that kind of disappointed market, but we were very happy to buy that. Again, pharma API Newland this year has done phenomenally well. Anyway, most of you, some of your this stock also did not. Last year, it had given us a bit of a pain when the stock fell down from 1800 to almost 1100, and we had taken the knock on our alpha and performance that in that quarter. But today, as you see, the ones only 2 or 3 quarters of numbers have come, and the stock has started touching 4,500, 5,000 range, and we think it's still continues to remain promising story. So there will be in businesses many times setbacks. They don't pan out. Businesses are not always perfect, but when you look at Newlet kind of stocks stories, they tell you that there are always opportunities to kind of build your position when market consensus call is different and you understand the business much better. And I think many of those calls have worked very well for us. PCBL again has delivered great returns for us, relatively underowned stock, conservative sort of numbers, but I think it's done very well for us. Anup Engineering, like I said, capital boosts, we continue to remain very positive, has become 2x this year. Ratnamani, again, conventional, very good company, very good management. We've been owning it forever. I mean, since 2020, we've been owning it, and we continue to own it. L&T, we've been owning since 900 rupees, so it's been a 3x for us since we bought. But this year itself has given phenomenal return. And Senco Gold, I spoke, it's up 80%. Scient DLM, we bought on listing. Again, it was not very well liked company at one point in time, but we've been bullish on that and we bought, and it's worked very well for us. SP Apparel, great play on kids garment exports, again has done very well for us. So if you see, many of the stocks which in our portfolio are very differentiated, non-consensus, but very, very good, high quality companies, businesses run by good teams and good management. Sometimes you got to spot them, and I think take bets on them early on. What didn't work for us, private sector banks, last, in the recent past has been consolidating. There has been a bit of a pressure on the NIMs, but I mean, profit growths have come, but, there is a view that, there will be profitability compression. So, so especially large banks have not done well, but, we are underweight on large private sector banks. We reduced our weight in ICICI Bank, which has been one of the most favorite pick in last 4 years and continues to remain so. But we made a bit of a tactical call. We think PSU banks in next 1 to 2 years will do far better. And I'll talk about it a little bit more when we come to sectoral view. But so we reduced that and added few PSU banks, and that has also contributed to our alpha. Large cap IT, like I said, we were underweight. We own only few names across various strategies, but mid cap IT has been our focus. Chemicals and niche IPA players, we took a contra position in last 3 to 6 months, and they haven't really performed or added so far. They haven't worked it, but anyway, they are contra bet. We think we bought them from a 3 to 4 year perspective, and we continue to remain bullish that while they might not have worked in last 1 quarter or 6 months, and we are perfectly fine there, but we think that they will deliver. But good part about this quarter or last 3 6 months, that nothing has negatively surprised us. Things have panned out very well across our portfolio on earnings side, and barring 1 or 2 companies where earning disappointments were there, but otherwise by and large earnings and everywhere, I think we've been generally our portfolio has seen good traction. So that gives us a sort of comfort that our portfolio approach, our investing style, investing framework, forensic research framework has worked very well for us. We have not had any sort of corporate governance excess, and we have always said that our biggest promise to our investors is that you should not find any corporate governance issue in our portfolio. And we are very, very, very paranoid about that. We do a lot of work on that. So I think fortunately we have not seen any of those any sign on that in this quarter as well. So very happy to report on that. Now coming to, I think, what do we see earnings, liquidity, and valuation from there? So, again, a lot of people keep asking these questions: Are markets expensive? Are markets valued? So markets are always valued based on three things: earnings, returns, and sort of growth, right? So if you see this quarter is one of the after a very long time, companies have beaten the market expectation. If you see in this, vis-a-vis expectation, revenue growth was 3.9% higher and earning growth was almost 1% higher than the market expectation, right? Markets have been on a bullish mode, we know all for quite some time, right? So this is after a very long time, I have seen, we see quarter after quarter earning that corporate earning was ahead of market expectation. And that is a very, very pleasing sign that, the underlying earning growth continues to remain very, very well. And, just to give little bit color on each of, I won't go much in detail, but I will just touch upon that. What is a sort of just one second. Yeah. So, each of so earning growth has been beaten. Some of the sectoral color, I will say, bank credit growth has been very, very robust across the board. Credit growth continues to remain 15, 16%. Retail credit is far higher. But India is still one of the underlevered country. Our total credit is only 77% of GDP, which is not very high. So we have still long way to go. We think that credit will continue to remain robust. 1.5 to 2 times of GDP will continue to go to be there. There could be some margin compression, but I don't think that is any major worry. In fact, there's a lot of write backs happening from the NPA provided earlier across the board, and we think that will continue to remain. So I recently met one of the PSU chairman, and he was saying that in fact my NPA pool is my gold mine because the amount of money I will be able to recover because I have anyway written off. So I provided for. Now money I am going to recover from that is a huge part. I mean, it was almost, he said, my 1 lakh crore pool of return of bad assets. Assume that even if I recover half of it, 40% of it, it is such a large pool of capital for me. Large pool. So this is what is happening. It actually went negative one side. Now the whole positive spiral and positive cycle is working for the sector. Same way. So we remain quite positive on the space. There will be, quarterly up down. I'm not worried about that. But structurally speaking, it cannot happen that Indian economy grows and banking sector does not grow. So I mean, we all know that India hit $4 trillion GDP. So that's a great news, and I'm sure it will continue to grow further as well. But so banking is like a bloodline for the economy. So I think it will continue to do well. Information technology, again, most people think that sector is not doing well. US recession is impacting them, but at least data news does not support that. Both large companies also have had good, strong deal wins. Now, think about it. If a US CEO or US company, knowing very well that there is a potential of recession or a slowdown, giving order or deal, it cannot be, it can't be it is a non-discretionary deal. It means they have to do this. It is compulsory for their business. So India is catering to that kind of need. Today, a lot of transformation, cost-saving kind of deals are coming. So we are not even yet seen we have not yet seen the developmental spend coming. Right now, it's only a survival spend or survival order flow which is coming in the IT sector. Developmental orders will come once the environmental settles down in US, which I think is at least 12 months away. So that makes us, slight comfortable more from a long-term perspective on IT. Even in current environment, IT will deal wins are reasonably robust. Delivery cycle might remain a little bit, more muted, but that is okay. That is more short-term than long-term. So we think that most IT sector will do well. Within that, there will be segments like ER&D, which will, or some of the product company or some of the a smaller company which will do far better. And that's the reason we've been more aligned towards smaller company which can grow far better than the larger company. Also, just because of sheer base effect, nothing else. So I think we remain, and I continue to believe that IT sector is the best play on US interest rates, because when the US interest rate starts coming down, that's the time the developmental spend will come from US companies. Today, they are only doing survival spend. And that's a critical difference that when the needle moves from survival spend to developmental spend, that time, they spend liberally, they spend more. And that is the time I think IT sector will see even further acceleration. And that's it. And we always believe that today, look at the valuation of IT and consumer. IT risk reward is far more in favor than consumer because consumer stocks are still, after so much consolidation, also are expensive and are expensive and offer the kind of similar kind of growth profile, similar kind of ROE, cash flow, everything else. Ancillaries, I think, we all know we saw a strong numbers, best margin, most OEMs reported, led by lower commodity prices, good volumes. There was a good volume beat across the board. Partly also because of the festivities. So I think auto sector in last 12 months has been doing well. We've been overweight on the sector for quite some time, and we see it continue to remain in that kind of trajectory. Uh, as long as there's an infrastructure development happening, CVs will do well, more cars will be sold. So we remain quite positive and optimistic on the sector. Capital goods, we have spoken that there's a massive spend happening across roads, railways, ports, airports. Across the board, there's a massive spends happening, and this is very well first reflected into the order book of the EPC companies. You would have seen L&T's order book is 4.5 lakh crores, 10% growth QOQ. This is like huge, and whenever such things happen, it tells you that order book is the leading indicator of what is yet to come, right? And that is a very um, good sign because investment cycle has a huge multiplier effect in an entire value chain. And I think that we are in the middle of a massive investment cycle over the next 5 7 years, and we can see that in everything. In fact, very interestingly, and we'll speak about a little bit more about it later, but we are starting to see a capex in a thermal power, which has never happened for last 10 years. In 2005 to 7 cycle, thermal power was one of the biggest driver of the capex cycle, right? Which was missing in last 10 years. We are beginning to see a massive revival around there as well. So I see a very very great infrastructure investment cycle continue to remain across the board. Uh, on the chemicals and APIs, the sector has gone through a difficult time over last 12 to 18 months, partly because of the inventory pile up at the end of the consumer and the users. And secondly, because of the price correction, which was largely led by commodity price correction. So that has gone through the pain. We think that, especially in case of many specialty chemical companies, the pain is more or less behind. There's a time for contra play in the sector, and we have picked up some companies which have corrected significantly, but they continue to remain very robust business models and sound players, and they will be here because we think that chemical as a theme is here to stay over next 5 10 years. It's part of our manufacturing theme. It's not going anywhere. So it's good time to take some kind of contra bets on that, and we have acted upon that. Pharma and healthcare, again, we saw a very good, numbers across the board, as primarily led by, the easing pressure on the US side. Most pharma companies which had exposure to US generic market were facing price correction over last 3 4 years, and which has started easing off. So you saw, reasonably good beat on the earnings across the board. Domestic market has been doing very well, but international market was a big of a pain. That is receding, and we think that will continue to do well. And I will speak about a little bit more in few more slides because I am covering this as a part of a theme. So, in earnings section, out basically, if I were to look at what we are middle of 20, 23, 24, so half of FY24 is gone. So, we see 18% kind of earning growth continuing even from a 25 perspective. And I think that is a reasonably robust outlook according to us. And companies across, and it's a widespread growth. So if you look at on this, it's not like it is concentrated in one particular segment or sector. It is reasonably is very well spread out. And I haven't seen this kind of scenario in many cycles before. That you are seeing earnings growth across the board, and that is the beauty of this side of the cycle. That you are seeing very well diversified growth. So you have choice to play. You have choice to do your risk reward. If it is always lopsided, then you will see bubbles building up in those buckets. Like what happened in 2009 to 14-15 cycle, the growth was largely concentrated in the consumer play, and hence consumer play became very expensive. Growth was largely concentrated in companies like HDFC Bank, and which is the reason HDFC Bank became very expensive, and because there was no growth elsewhere. So whenever there's a well diversified growth, it is always robust and good for the market. It stops from a bubble to from building a bubble in the market, and that's a very good sign of this market as well. Where are we in the corporate earnings cycle? If you look at, we earlier also spoke about in our earlier call that, corporate profitability is a percentage of GDP is picking up, and we are continuing to see pick up in that. We are right now at 4.7%. In the COVID, we had gone down, to 1.5%, but it's on uptick. In the previous cycle, it had peaked out at 6.3% in FY8, right? But we think that it will continue to, even this time round, it might beat that ratio also, because a lot of reforms have been carried out in the recent past. Those reforms have led from parallel economy, like something like GST has moved a parallel economy into corporate, which was not there before. So a lot of things which have done been in the last 5 years from a reforms perspective, they will add to the corporate profit more than ever before. So I would take a reasonably high probability or a bet that this time around we will, from corporate profitability to GDP ratio, we will beat even the previous cycle or previous high of 6.3%. So I would say we are still well in the middle of the earnings cycle. So there's no need to worry that this can kind of taper off from here. Are we at the peak? Are we at the close? Corporate earning to GDP ratio still has a long lever led by infrastructure, manufacturing growth, our services growth. So, I am actually not at all worried about on this part of the ratio that, how much is more left ahead of us. So this was about the earning, which is, I think, which I kind of, said that this is we are in a good shape, and it's likely to continue at least, in next, 3 to 4 years. Of course, we'll keep revisiting, but that's the current view. Now coming to liquidity, which is the most important from a short-term perspective also. So, we saw early signs of FI flow coming in the March when, dollar interest rates were peaking out. And so we saw money coming in. And then around that, again, we saw interest rates spiking in US, which stopped the, flow coming from FIs, right? So basically, one funda all of you should know that in emerging markets receive flow from US or developed markets whenever interest rate starts coming down. Whenever Fed raises interest rates, money goes out, because the raising of interest rates impacts emerging market negatively, right? And whenever rate peaks out and starts coming down, money comes back towards emerging market, right? It's a long held 30, 40, 50 year sort of thing you've seen, right? So, and we saw interest rates spike or yield spiking in US, and hence we saw money stopping. But we think that that money will sometime return, right? And I think US interest rates are peaked out. You might argue one more quarter, another 25 basis point possible. I'm not, but it is probably 3 to 4 quarters away from they start coming down. And once we start seeing them coming down, then you will see a meaningful trend of FI flows coming through. In last 4 years, we have seen almost $45 billion of outflow from India from FIs. Imagine, what happens when that comes back, right? Because our domestic liquidity continues to remain strong. In this current calendar year itself, we got 1,68,000 crores of money from the domestic market through SIP, which continues to remain very robust. This month itself, we got 16,000 or 17,000 crores of SIP flow. So the SIP flow is where domestic liquidity, domestic savings moving from other asset class to equity continues to remain very, very robust. And that's our one of the biggest saving grace. But I want all of you to imagine that if this is strong and if all the FI money comes in, what will happen? I do believe that there will be a scenario, whether it is 12 months, 24 months, I don't know. It could be, 36 months. As and when US interest rate starts coming down, yield starts coming down, we will see an avalanche of flows. And when combined with the domestic liquidity, we will see a bubble kind of situation getting built in India. Of course, that time we'll worry about that. But right now, it's an opportunity that, and that's why I tell people that, do not wait for, I mean, any correction, any time is a good time to deploy money in market, because that money will come. And And another interesting point, also you must know that India is one of the most significantly underrepresented market in a global portfolio. See, total global market cap is $115 trillion. GDP is about $80 trillion, 80, $85 trillion. So roughly about 1.5 times, right? India is at $4 trillion. Right? Our market cap is again $4 trillion. So even if we don't, by that logic, we should have 5%, representation in the portfolio, right? If I were to take India GDP versus global GDP, 4 trillion divided by 85, we are not 5% weightage of the global portfolios. We are far, far below that. So, if India is one of the most promising market around the globe, you will see a lot more liquidity coming. And that time may be just some time away. But when that comes, that will be very, very sort of significant money flow coming in. And that will drive the market. We all know that liquidity drives market in a shorter term and medium term. Valuation, we don't think India is expensive. I think it's not cheap. It's not expensive. It's in fair value zone. 18% earning growth over next 2 years, at 20 times, PE for, FY24, and, 17 and a half times for 25. It's again in line with 10-year average. And especially when so much of reforms have happened, so much of structural reset has happened. Why India will, continue to trade at 10-year average? I don't think so. So I continue to believe that there's a further scope for India to get re-rated. I see a situation when the liquidity also supports. Probably India will trade at 25, 27 times of price to earning in next 2, 3 years time. I don't know when, but it will continue to trade in that kind of. It will happen. And we will talk and cover this in one of our future quarterly earning calls. This, one of the calls I had made this presentation, and I don't know, some of you remember that valuation of any asset class is function of three things: ROE, growth in earnings, and interest rates. And if you see, all things are India's ROE is at 15%, earning growth at 18%, and interest rates are, one of the cheapest ever. In difference between India interest rates and US interest rate is lowest ever. So if you all three are working for you, why India should be ever cheap, or why should India trade at a 10-year average? India should trade definitely at a premium, right? But India is trading at 10-year average. It means there's a further scope for re-rating. And our view is that India's ROE will continue to remain robust, India's earning will continue to remain robust, and interest rates are further looking down. So all three are pointing in the right direction. So we are not really worried at all about valuations. Of course, there will be some pockets of overvaluation, exuberance, which are there, which will always be there, which were there in every cycle. There will be some exuberance will be there. You have to avoid those things, and that's where your investment framework, your discipline, your should come into play. That the markets are not to be blamed for that. If you are buying and falling prey to those bubbles and euphoric segments and sectors and stocks, it is your fault, not market's fault. And at least we believe, and we like to I hope that we never fall prey to that. We always avoid these kind of things, and our investment framework allows us or forces us to kind of stay disciplined and avoid those kind of euphoric sector segments, so that the unwanted risk does not come into our portfolio. Yeah, so I mean, I've just to summarize, I think manufacturing capex is happening, export is picking up, current account is more benign, and we think over next 5, 7 years, India will become current account surplus country. And whenever any country becomes current account surplus, the country's sort of there's a huge change happens in the country's sort of profile, right? Only 4 countries in last 40 years have become from current account surplus deficit to surplus: China, Korea, Taiwan, Japan, right? And it has a golden period post that. So I think India somewhere, whether in next 3 year, 4 year, 5 year, I don't know, will cross that. And when that happens, your currency pressure goes away, your ability to manage your own interest rates becomes very easier, and the country gets re-rated. And it's a very simple thing to understand in a way of common language, that our earnings are more than our expenses, our exports are more than our expenses. And what happens to any individual's life when the earnings are more expenses than uh, more earnings are more than the expenses? Same thing will happen in the life of country. So this is very, very big re-rating moment waiting to happen in the life of country, and I do believe that will force rating agencies to upgrade India. All those things are potential over next 3, 4 years. So I think India looks very good, from all perspective. Profit cycle is good. In Indian equities also have a low correlation with US growth, oil, all those things. It's a low beta than any other emerging market. In fact, one of the fund managers sent me from China that showing correlation beta vis-a-vis Chinese market over last 20 years. So India has a great low correlation and a high return even vis-a-vis Chinese market across all time periods, not the recent past. So we remain positive in India from short term, medium term, and long term perspective. We think mid and small cap are real pot of opportunities. We get amazed when we meet companies, what is happening in this country, the kind of entrepreneurship is thriving. Many companies' business models are scaling up significantly, and we derive a lot of sort of comfort and energy from that fact that India's is a very widespread diversified opportunity. And I make this statement many times jokingly that we are spoiled for choice. People say that, are you not worried about risk? I think, and I say this, we are spoiled for choice. We have no shortage of ideas. Today, in fact, you have to make the choice that how do you compress your portfolio and how do you kind of, stay focused. But today, there's no choice, no shortage of. It is in idea. I think quality of the promoters, quality of the management, quality of the business model. There are many of them, and so we don't subscribe to a philosophy that there are only 20 companies with a good governance and good business model. There are so many in India. So risk reward is favorable. We expect India will do very well, and India remains one of the best market, globally, and likely to remain so, and that will attract future capital. Oh, I slightly out of place, but this is sorry, I think it's slightly out of place, but this is the India capex cycle, by the way. This is the index, which is a combination of central capex, state capex, private capex, aggregate order book, and index. This is how this index is growing, right? So it is, since 2012, it is at 3x of 2012. Of course, it's a limited period, but I'm just trying to tell you this is happening. And capex is one of the biggest driver of economic growth. If you see 2003 to 2008 cycle was largely led by capex. India will spend $1 trillion uh, in next 7 years on infrastructure alone. So all those things give you a lot of comfort around what could happen to the economic growth. I wanted to share with you two new themes which we have picked up. We think they will do well, which I promised you that I'll touch upon later. I didn't cover in the sectoral outlook. Pharma and power. Let me first talk about pharma. So pharma as a segment has not done well for last 7 8 years. It has delivered no returns. Of course, there was a time when it created significant wealth. I have seen some pharma's market cap growing from 1,000 crore to 3.5 lakh crore, and after that it came down, became one third, and remained stagnant, and many more sector and many more companies like that. But I think primarily led by significant deterioration on the business matrices in the US market. US market distribution got consolidated, margins evaporated. Companies just to meet their fixed expenses were forced to sell medicines abroad, and as a result, for last 4 5 years, as a result of that, most of the companies stopped supplying. Only were doing marginal business, or what business they needed to do. They were not really investing more in US generic business, and as a result of that, in US they have a serious shortage of medicines now, and which they witnessed in the last 2 3 years. So that has forced them to think what needs to work. So recently, first time US FDA chief came to India, stayed here for 10 days, met a lot of pharma companies, gone around, seen them. He came to assess what can be done. And I think that was a very positive sign. In my opinion, any regulator, they are suffering from serious medicine shortage. And when the regulator comes and visits first time, stays in the country for 10 days, tells you something, what he speaks and doesn't speak doesn't matter. It tells you what their action is, towards. So we think that US generic pain point is kind of slowly easing off. It will only ease off in times to come further. Domestic pharma market was anyway doing well and will continue to do well because more and more money is being spent on improving health. Medical insurance is covered. Government is providing a lot of free medical to poor. So all those things are going to drive the US the pharma sector. So we think pharma and healthcare will continue to do well, and within pharma and healthcare also one segment which is CDMO space, which we like a lot. It is very very structured in nature. A lot of these innovator companies outsource their drug discovery, development, and manufacturing work to companies abroad. China is a very large player. And I know from our interaction with many players, we have seen this is again a 10, 15, 20-year kind of thing, which is just like how IT was in, mid 90s. This boat has sailed. According to many CDMO companies will become 5x, 10x from here, and maybe more, because this is a very large segment, very large sector. What we are seeing is just a beginning or a scratching of the surface. We hardly have 4 or 5 CDMO companies. More are coming, more are getting funded. So that's a one segment our eyes are very, very closely watching, and we will, of course, we have taken some bets on that. Hope they play out, but we remain very positive on that as well. So this whole space we are very, very closely watching and monitoring, and we are quite positive about. Second thing which we picked up, or is power sector. So if you see in last 10 years or 15 years or 10 years or so, no new segment or new investments came in a thermal capacity. All talk was about renewable, wind, solar, right? And most of the thermal capacity was either in distress. Some of them got consolidated through NCLT process. But fact that demand was growing, right? It might be growing slowly, but it was growing, and especially with the manufacturing activity picking up in India, you need power. With the new infrastructure activity, whether it is metro or any other thing, you need power. With the new residential activity picking up, a new building comes up, consumes more power, right? So everything is, growing well. And lastly, we don't realize one of the biggest consumer of, we all use more of mobile and data everywhere, right? But one of the biggest consumer of power is data center. So they say data centers are new factories. Data center capacities are measured in megawatts, right? So they are also becoming big guzzlers of power. So India is staring at a shortage of power, and there is no other option but to start putting up thermal capex. So there are various estimates between 30 to 45 gigawatts of new capex will come, and that is making us positive on some of the companies, whether it is capital goods companies or generators. So there are obviously nuances you have to watch out. I'm not saying that everything will do well, but at least we have picked up few stocks, few names which we think that will become 2x, 3x in next 3 to 4 years, and very well placed. So whenever you see this kind of setup, you don't have to think much about it. At least because power shortage is something no government can live with, nothing can kind of. So yeah, this has to happen. It's very high probability for it to happen. So these are the two things which we recently picked up and added, and we've been kind of playing around. So yeah, so these things are the two themes. Maybe some quick talk on the risk. And we have risk, yeah. So risk which markets are prepared for. So one of the fundamental belief around risk we have is that risk always comes unannounced. The only thing is are you prepared for or not prepared for, and that will determine the impact of that risk on the market, right? So markets are prepared for if there is a state election outcome is adverse. I don't think market will get worried. Market is factoring BJP will get one state. So if they don't get one state also, I think market probably will overlook. But if they get two state, market will be positively surprised. So I think the election, I don't think much is sort of worried about. Even geopolitical, currently we've been seeing huge amount of geopolitical since Ukraine war continuing, and I do believe that we are in a sustainably unsettled geopolitical environment for next 5-10 years, because it's real issue with the Cold War between US and China, and that is unlikely to settle down anytime in a hurry. So we will remain, in a heightened geopolitical environment, which will of course bring tension time and again. But I don't think this will adversely impact India. In fact, some of the things help India, because India, that accelerates the China plus one strategy. So from a business point of view, so we think that that's not a big worry. Markets are not prepared for if there's any adverse central election, non-BJP government comes. Definitely, markets are not prepared for, and you might have a serious sort of cutback on markets or sell-off in markets. Any unseen event like cyber attack, biological attack, they are, I think, in my opinion, they are reality. They are not theoretical. We have seen many companies have been getting cyber attacked. We had, one company, in Q1, their entire systems were attacked, encrypted by the cyber attackers and hackers, and they couldn't sell for a quarter or so. They had to revamp everything, and well, of course, they came out of it. But these kind of risks are there, and these are the risks you can't prepare for. And we think that uh, they will be around, and you can't model them for anything else. But what gives us the biggest comfort in the risk is that today, biggest risk, if you ask me, especially from a short-term perspective on the markets, come from leverage, right? You know, so this time around, because when a levered person says he does not see the price, he does not see the fundamentals. So today, thanks to SEBI's huge amount of tightening over last few years, the leverage is very very low in the market. Whether margin funding books of brokers or even the F&O funding, F&O position outstanding, I think they are not very alarmingly high. So that's the reason if you see, you don't see major sell-off when the negative news develops in the market. They get arrested very fast because a non-levered person will not sell even if the stock price falls by 20%. He will wait for it to recover. But a levered person has no choice but to sell, even if it falls by 40%. So that's a very big comfort. So today, your market participants are not levered, and your corporate India is not levered, and even government is not levered. So, leverage is what brings what exaggerates the risk. Whenever risk comes, it gets exaggerated by the leverage. And because leverage is not there, we think your wide volatility will not be there. And that's why you will have a lower volatility, range bound volatility. Volatility is here to stay because, you can't ignore, you can't avoid that. Any development happening, any part of the world can bring volatility. But the range of volatility is going to be limited. And that is our biggest comfort in the markets at this point in time. So I will pause here. I've spoken enough. Hope I have many of you are awake. Uh, would love to sort of hear any comments, suggestion, and if there are any questions, would love to please feel free to raise sort of hand or ask question in chat. Yeah,
Vikas, we have a few questions in the chat box from Aniket and Shiva.
let's take that. Due to base effect, would there be slowdown in the growth? I address that. See, many levers of growth are there. When you have acceleration, the infra spending, the way it is happening, when you have acceleration in the capex cycle, the way it's been happening, I don't think, that still we are at this where the base effect is there high enough to slow down the growth. So for the levers I mentioned to you, I don't see that as a big risk. Corporate profitability breakup in terms of large, mid, and small cap. Is small cap, mid cap profitability increasing greater than the large cap? Well, I don't have the data right now, but would be happy to look at. But I don't think if you ask me, there will be very big difference. Of course, couple of points of difference will always be there in small and mid cap because they come with a lower base. And like I was explaining in case of IT, today when the IT sector is growing, smaller companies are growing faster, right? So same way when the country is growing, small and mid caps are supposed to grow faster because they are having a lower base effect. So I would assume, without having a data in the hand, that mid and small cap would have slightly higher, growth. And but the percentage, I don't know what that would be. Why was the benchmark for capital compounder PMS changed to from 500 to BSE 200? Good question. This was a SEBI diktat. I think recently, SEBI, when we started our fund in 2019, we chose BSE 200 as a benchmark for everyone, but for all our products. But I think about a year ago, SEBI gave three choice to all the PMS managers to pick up one benchmark across all strategy, whether you are large cap, mid cap, whatever it is, you don't care. I mean, you can only choose one out of three benchmarks. And so we picked up BSE 500. There was no others were one Metropolitan Stock Exchange benchmark, and other was NSE. So we felt BSE for because it was, I think, cheaper to buy that. So it was a pure cost decision, nothing else. And it, frankly speaking, it makes no difference beyond a point. So you have to choose one benchmark. But we found slightly unreasonable that comparing even your mid and small cap portfolio towards BSE 500 is not right. But so when we talk to investors, when we evaluate our performance internally, we look at all benchmarks and see whether we are beating that or not. But yeah, for reporting purpose, I have to use what is given by the regulator. If US interests come down, would there be more outflow from India since US equities are cheaper than India? Well, I think, if US interest rates come down, like I was explaining to you, whenever US interest rates go up, they pull out money from the emerging market, because when the interest rate goes up, most emerging markets are current account deficit countries, so they import inflation. And as they have inflation, their interest rate goes up, which has a negative impact on equities as well as their currency. So, because of this, they pull ahead of the actual playing of the interest rates. And when that changes, reverses, it comes back. So, emerging market, in fact, receives flows. It is not about one market being cheaper versus other market. Each market has its own valuation benchmark. US market, I don't think US market, I can say US market is cheaper than Indian market, because again, like I said, it's a function of three things: ROE, growth, and a discounting factor, right? So I don't think that will happen, and that's not, at least how, based on my interaction, investors think. Uh, they have allocation towards, based on their overall view on the interest rates and each asset class. And what you have seen is, as the interest rates peak out, it starts coming down. Emerging market in general receives huge amount of flow. It happened in 2013. It happened before as also. We have studied it for last 40 years. This has happened. Last week, meeting chaired by Ministry of Power and Industry, it was conveyed by the government that India will add 80 gigawatts in the next few years. Thermal power will get the importance long overdue. Yeah, valid comment, Rajiv. I think that's what I believe, that huge amount of capacity will be added now. Because you cannot run manufacturing on thermal power, solar power. It's not a reliable power until the storage answer is found. Solar and wind will become reliable power only when storage answer is found. Till then, we will have to rely on thermal power, and I think that is bound to happen in times to come. Yes, Amrit Kal is here. No doubt about it. You will see here very soon announcement from us in next few weeks about our new fund. So I don't want to say that right now, but you're right. Amrit Kal is here. My view on rupee dollar from mid to long term perspective, like I said, that my view on rupee is very clear. From a medium term to long term perspective, India will migrate from current account deficit to current account surplus country, and as it becomes surplus country, you know, basically you can manage your currency very well, right? The reason, see, when you are a deficit country, every time the deficit goes up, you fund it through capital flows. When the capital flows weakens, your currency comes under stress, right? So today we have a strong capital flow and strong current account position, which is improving. So as manufacturing picks up, as IT services picks up, as pharma picks up, you will see our current account sort of getting bridged. And I see, if I were to look at, let's say, I have said in the past also that we all grown up thinking that rupee will depreciate 4 to 5% every year. In my opinion, that is history. If I were to say 3 to 5 years down the line, probably we'll be more closer to what we are today rather than more 90 or 100. I don't think in rupees going there. On a relative basis, if all currency adjust, I mean, on a relative basis, we will be having a ratio here only, right? Considering the uncertainty in IT front, should now be ideal time to invest or hold and invest after a couple of months? Look, again, I don't think there's uncertainty in IT. Like I said in my talk, that the narrative is that there is uncertainty in IT, but within that uncertainty only, we picked up five stocks which have delivered 80 to 200% return, right? So it's not really about, we don't think there's uncertainty in IT. There's a survival demand which is coming about. Growth demand will come, developmental demand will come. So we will evaluate companies based on the individual, and we are not worried about the macro demand environment. We are kind of evaluating companies based on what we like. Macro demand environment is not negative; it is only benign to positive. What's your view on real estate sector proxy companies in construction and engineering? We have a very good view on the real estate. Real estate sector will do well. Job creation is happening, robust. Is very robust in the country. Housing sales are doing well. So real estate sector will do well. There's no doubt on that. And again, that is reflected in the order book of a lot of EPC companies. There are now, so with the RERA coming through, a clear distinction has happened between developer and the builder, right, or construction company. right? So if you see the company which build buildings, residential buildings and all, their order books are very, very robust. And so I continue to believe that it's a very, promising sector. Do I see renewable power sector? See, renewable power sector also will grow. I'm not making a point that renewable power sector will not grow, but I think I can't find today how do I play that sector from listed market perspective, at least within our risk reward framework. So we haven't so far got any, solar. I mean, there are some companies, but some of them don't fit in our forensic framework. So I have to make sure that corporate governance, forensic framework, and business model and management, all those things turn out to be right when there is a uh, uh, sectoral tailwind. At least we haven't found any so far, so we have stayed away from this. But yeah, it's a promising sector. My view on China market valuations, no view. I am not a China expert. I only know from afar sitting here that China has its own challenges. Whenever a country goes this kind of challenges, it is unlikely to create shareholder value. I mean, I remember 2, 3 years ago, a lot of people invested into China, thinking that it's cheap. But in my opinion, at that time also I used to say that when you have the best market ahead of with you, why would you go and just because something is cheap you will buy? I think you should buy not because something is cheap, but you should buy just because something can grow and sort of evolve. And I am not a big sort of believer in Chinese market, but my view is as laymanish as it could be. So take it with a pinch of salt. Next question. Yeah, last 1 year shift strategy has performed done well. Do you recommend this profit booking and shift strategy? And if you there is any additional money should invest into capital compounder? I think our shift strategy has delivered 45% CAGR over last 3 years, and every year I get this question that should I book profit? And my approach always has been in investing. I've been doing for 25 years. Never sell your winners. There's a reason why see you will like try to book profit when you see this is an artificial or it's not sustainable. And frankly, I don't know whether tomorrow it might happen next 2 quarters. It might not do well. That is in nobody's hand. But when we launched the strategy, we said it is a 10-year theme. Today, we are saying it's a 10-year theme. It's only getting better and accelerating. So I don't see any reason. And if you see our valuation, shift strategy, portfolio level valuation in 21, 22 times P, so it's not expensive. So I don't see any reason why one should sell, but your call. My view is no. You should stay invested. Don't sell your winners. You should continue to remain uh, invested in that, and theme is only getting bigger and better. One next question is from Pallav that many US credit risk expect credit risk in US because interest rates are high, and so uh, also the US has been is used to zero interest rates. How this higher or longer will affect US and global economy? See, today US is one of the biggest pain point or biggest worry point for everybody. Well, like you are asking, this is a common question everybody is asking, right? That if why how come despite such a sharp rise in the interest rates, no systemic issues have come out. Partly SVB came and that got contained. So that's a very big question, and many experts. I am no expert in US, but experts are predicting this kind of thing. The only thing which I can say is two things that we don't know whether US will blow up or not, right? First of all, I think this time around debt is largely within the government rather than the private. Corporate sector in US is not as leveraged as it was in the past. But anyway, that is not the point I'm making. Assuming that tomorrow US blows up, what is relevant for me to what will be the impact on India, right? Because that is what at least we do. At least that is what we do. So will the impact will be same as 2008 crisis or no? Answer to that is no. And that is where I would like all of you to, pay attention to this, why it will not be as painful as 2008 crisis for two reasons. In 2008, you know, when we did not have mortgage crisis, US had mortgage crisis, but why did we import that crisis in India? Right? For simple reason, in 2008, most corporates, whether it was Tata who had bought JLR, Chorus, Bharti had bought MTN, Birla had bought Novelis, many companies had done global acquisitions, doing global borrowings. Also, that time the corporate borrowing in form of ECB and FCCB was very, very high. So when the funding dried up in US because of mortgage crisis, all the stress on the companies which borrowed money from them came home back. Tata Motors suddenly became bankrupt company. Hindalco started looking like a bankrupt company. Bharti was like chance of survival were questioned. So all those things were back imported into our local balance sheets. Right, the stress was here, so it created a big stress. Secondly, last time around, our entire banking sector, right? And we had written a note on this, it's there on our website. ICICI Bank had a 30% balance sheet coming from global markets. Likewise, most large banks had exposure globally. So when the global stress happened, in those markets, it came on the local balance sheet. And if you remember ICICI Bank, there was a bankruptcy talk and, there was a line on ATMs for cash withdrawal and all. So we imported that. Now, fast forward this time around, none of our Indian corporates have done global acquisitions. Our corporate India's global borrowing is almost negligible. In fact, this time around, whatever global borrowing in form of ECB, it's not in form of ECB, it's in form of bonds. So bond is a fixed tenor, 10-year, 15-year kind of bond that does not bring any stress on the corporate balance sheet. It brings stress on the corporate bond pricing. That companies don't care, right? If Vedanta bond prices goes down by 50%, companies does not become bankrupt. Of course, investors have to worry. So today, the corporate borrowing, international borrowing is very robust. It is unlikely to put any stress if US were to, let's say, blow up, or our banks are unlikely to get impacted if US were to blow up. And lastly, this time around, our forex reserves are far more solid and well placed than what we had in 2008. So, if I were to look at all these things, impact of any US crisis will be limited on India. It will not be like how it was, in 2008. I'm not saying it won't be any at all there. Sentimental impact will be there, but it will be limited on India. Your thoughts on agrochemicals sector? We like it. I think agrochemical sector is sort of coming back. So demand is coming back. A lot of inventory clearing has happened, and that I think is really creating. So we have bought recently some agrochemical stocks, which we think post inventory corrections will do very well. So I think that's a good sector. Um, uh, uh, from Akshay, hi Akshay, do you think recovery in rural market will be temporary, driven by central election, or will it be continue to post-election and consequent impact on two-wheeler sales? See, I think there are two situations. I think there is definitely a stress in the lower middle class, or I would say not lower middle class, but sort of there's a poverty line below class, and then there's a lower middle class and then middle class. So middle class and some part of lower middle class has some kind of stress because inflation has been very, very high, and inflation is not necessarily only the reported number. Inflation is also because keeping in mind the aspiration of the people, right? Even if I'm a lower middle class, I am wanting to go for better education, better equipments, better everything, right? So why the income is not keeping pace, and that is creating good amount of stress. So, there is a K-shaped recovery in all markets, including rural markets. In rural India, there are people who are doing very well because of the wealth effect, because the land prices have gone up and, election funding, of course, we all know that is doing well. But, so I think rural India uh, the recovery will continue to be in this space only. Of course, all governments are trying to reduce the rural stress in form of increasing bit of the MSP, providing bit of a boost to the agricultural income. It is again also market specific. Like UP, rural India is doing very well because the sugarcane acres have gone up and people are doing well. So I would. It's a very interesting question you asked. That it is also very state specific, market specific. You can't have one point of view across India, right? Why UP agriculture, rural India is doing well versus, let's say, state like Telangana, or to some extent, I think state like down south, some states have some stress, right? So it's again dependent on what's happening in those particular states, including the boosting the structural income of those segments of the society. Of course, freebies are being given that adds to a bit of a comfort, but those freebies are always around the elections, not forever. Good part is that India has effectively implemented universal basic income by sustainably giving DBTs. that is helping to reduce the rural distress. So I would say that it's not alarming, but it needs to be addressed. If you have to see some structural recovery in the rural demand, till then you'll have to be mindful of that fact while playing your investment strategy. And that's the very reason we have stayed away from most of the consumer plays. In last 3 4 years, we have not got our arms around or comfort around buying some of those names. What is your opinion on new age companies earning potential in just 1 second. What is your opinion on new age companies and earning potential in the B2C areas? So I think new age companies again, we have stayed away from them. Of course, companies like Zomato has done well, Paytm has done well, recovered well from there. But still, from our investment framework point of view, we have not been able to, kind of find an answer to some of the how do you value these companies? How do you see? So if I were to say, let's say Nika, it's a consumer company. It's a good company, no doubt about it. It's a consumer company. Now, how do I value this company, from a profitability point of view, TCF point of view, or even if I take 10-year growth? So we are still not able to kind of find our arms around. And it's okay to miss out when we are able to find three bagger, four bagger in our sectors, which we understand, which we have our comfort around. So we have kind of, while we monitor that, but we have not really bought anything significant or anything meaningful in that. Your view on muted top line growth of Indian corporate, particularly large caps, as majority profit growth has come because of the margin expansion. Don't think so. It's a very, it's again, it's a function of how inflation also pan out, right? In a low inflation environment, obviously, top line growth has to be, volume growth and top line growth has to be there. I'm just pulling out the number if I have in front of me. See, you've seen, so now the top line growth is also a function of, it's 11% growth. Top line growth is also a function of what do you call, inflation, right? So we have seen tapering of inflation across the board in commodity prices and all. But, margin growth doesn't get compromised, right? And same thing is, so I don't think it's a big of a worry. What we actually track is the volume growth, or what we like to see is the volume growth. Value growth is a function of a lot of other things, input prices, how are they moving? Many times, companies can grow top line of 20%, but profit grows only 15% because the commodity prices have gone up, and that necessarily will not expand their margin. So I would say that, and we also get worried whenever there is above average non-sustainable margins come in any company, then you have to, sort of adjust them for that. These are not sustainable margin. And that's how we at least value companies. Can you share some light on your exit strategies? We like to exit broadly under four situations. Number one, when we think our hypothesis, what we made has gone wrong. It was ab initio wrong. We made a erroneous hypothesis. Second is that when we believe that whatever hypothesis we made, something material has changed around that. Thirdly, when we believe that whatever growth we has adjusted, it has fully played out, and the risk reward of remaining invested is not there. And lastly, when we think that there is when we find a new idea, we compare this vis-a-vis some stocks in our portfolio, and we see whether the new idea is better on any risk reward parameter than the existing portfolio. Then we evaluate and see if it's better to switch or not. Otherwise, we stay put. So these are the four situations we kind of sell. Our approach is generally not sell just because it has made money. If the business grows, continues, because I have seen in my career stocks becoming 50x, 100x. So there's no point in just getting itchy when something is working well. You stay put and kind of compound your capital. While benchmark outperformance is there in compounder strategy, but a peer comparison with similar location strategy reflects better performance from likes of iPro, Contra, and Abacus Multicap. Your views on this, please. Our approach has been, see, there are a lot of good people in the market. There will be a lot of great people in the market. We respect all of them. We like all of them. If you ask me, We don't compare with anybody. We don't look at our performance with anybody. They are great people. They will do well. Our objective is to outperform in a multi-cap strategy 3 to 5%. And that is what I think we have delivered. We've beaten on that. Many times I have seen in many products comparisons, people will pick up somebody's multi-cap, somebody's, let's say when I say flexi cap, it might have 20% large cap, 30% mid cap, and 60% small cap. But that is not given in the numbers of the performance. And I'm not making comment on anybody specific. I'm just saying many times it is not an apple to apple comparison. But frankly speaking, we don't compare. And if anybody finds competition is better, most welcome. I am not saying out of any disrespect to anybody, but we believe that we are good doing what we are doing. We have a particular investment philosophy. We are happy to explain our investment philosophy. There will be periods of good performance, there will be period of bad performance, but we think over a period of time, over next 5, 10 years period, uh, we will be able to generate a very good alpha. We will be able to pick up themes like manufacturing, where I haven't seen any product in the market where there's a 23% outperformance for a 3 year period. So I don't know what one compares with. So I think I would say that there are all kind of products, and there are very smart people, including Abacus, iPro, in the market. We have full respect for them. Uh, which three sectors you are most bullish and bearish? I think I covered that in my whole presentation was about that. Uh, Nick, is Carnelian is the only asset management who has been proactively talking about probability of India being current account surplus down the. We fully are believed in that. So thank you very much for the comment, Aniket. But we are fully convinced on that. In chemical sector, what we prefer, commodity chemical versus we prefer clearly specialty chemical. In the commodity chemical or bulk chemical space, China is very strong. They can give competition anytime. It's very volatile, so we like to buy companies where there's a value addition, where the gross margins are in the range of 50 to 70%, so that they have ability to absorb any kind of volatility in their business model. So we will never buy bulk chemicals, commodity chemicals, because that's not our strength. Our whole thesis is to buy company which are into value addition, specialty chemical with a 50 to 70% margin space. Any sectors looking overvalued in the market? I think there are pockets. I think defense is one, railways are one. There are significant. I think there is a euphoria in some segments where I think one should be very careful. I'm not saying they are not good growth area, but today when companies get traded 120p, 140p, or whatever, 20, 30 times multiple of revenue, it's capturing far growth, right? So unless there's a very strong reason for one has to remain invested, otherwise I would say that one has to be careful of some of those names. So yeah, but I don't find a huge euphoria in the market across the board. But he's asking, I think AB and on value on chemicals. I think I've already spoken. Senko is a consumer play. Why do you prefer? I think I said that Senko is something what we like. When we bought, it was available at 20 times P, 20% growth, 20% plus ROE. We like the management, they are committed management, huge runway for growth. And that's the reason when and we did our forensic research, we found, them very good. In jewelry business, we all know that we have had more accidents than the success story. So you have to be 200% sure about the governance, the integrity of the promoter. And when we did our work on that, we came back very impressed. So we said, it's a mini Titan. Of course, Titan is a great company, but it's a mini Titan probably. So, when you are getting a reasonable good valuation, all risk reward and odds are in your favor to invest, and that's the reason we invested. So I think, I have kind of covered most of the, what's your portfolio turnover ratio? We churn very less. Again, depending on the strategy, I think we will be anywhere between zero point 0.1 to zero point 0.3. Our idea is to, but we don't mind churning more also if we are convinced that we need to do. So we don't get guided by that we have an outcome of turnover ratio. We are guided by what needs to be done in the right spirit of the portfolio. Tomorrow, if let's say I have to churn my entire portfolio, if our views change on something, we don't mind doing that. So that is our approach. But yeah, we don't churn more. We like to hold our winners for a long period of time. So that is the yeah.
So I don't think there are any more questions, but if anyone has any more questions, then feel free to drop in the chat box or raise their hand. And you can also connect with us via our website. I don't think there are any more questions, Vikas. It's
Okay,
been
so great, Viraj. Then thank you very much. Thank you everyone for being patient listener. Like I said, I do look forward for this conversation every quarter, and I hope we have made some brought some clarity to you how we are thinking. But if you have any questions or any more suggestions, please feel free to write to us. We are available, and I do look forward to many more such questions, conversation in the future. Thank you.